Commodities are the building blocks of the global economy. From the food we eat, to the energy that powers our homes, and the metals that build our cities, they play a crucial role in our everyday lives. But what really drives the prices of these essential resources? Understanding the forces that shape commodity markets is critical for producers, traders, and even policymakers. So, let's dive into the key factors at play. The global commodity markets are a dynamic arena where the forces of supply and demand dictate the availability and prices of the raw materials we rely on every day. From oil and gold to wheat and metals, the balance between how much is available and how much is wanted shapes the global economy. But what makes these markets so fascinating is the intricate dance of factors influencing this balance. Let's start with the supply side. One of the biggest factors affecting supply is production levels. For example, the amount of crude oil extracted by countries like Saudi Arabia, the United States, and Russia can send ripples across the world, significantly affecting global oil prices. But production isn't the only thing that matters. Natural conditions play a huge role too, especially in agriculture. A severe drought can reduce crop yields, tightening supply, and pushing prices higher. Technological advancements also have a major impact on supply. Improved extraction techniques like fracking have unlocked previously inaccessible oil and gas reserves, while genetically modified crops have boosted agricultural output. These changes often lead to increased supply, which can lower prices. On the demand side, things are just as complex. One of the biggest drivers of demand is economic growth. When economies expand, they consume more energy, raw materials, and food. The economic health of powerhouse nations like the United States and China plays a massive role in determining global demand for commodities. Then there's speculative demand. Investors and traders often buy and sell commodities based not just on current supply and demand, but on their expectations for how these will change in the future. Their actions can drive price fluctuations, sometimes decoupling prices from physical market reality. The next critical element is geopolitics. Geopolitical events can profoundly impact commodity prices. Oil markets are especially sensitive to political instability in regions like the Middle East. When tensions rise, fears of supply disruptions can push prices up even before any actual disruption occurs. Agricultural commodities are also vulnerable. Conflicts or political instability in major producing regions can lead to supply shortages. A recent example is the conflict in Ukraine, one of the world's largest grain exporters. Such disruptions can cause global prices for wheat or corn to spike. Trade policies and economic sanctions are another piece of the puzzle. When countries impose tariffs or sanctions, they restrict the flow of commodities across borders, tightening supply and driving up prices. For example, U.S. sanctions on Iran have significantly affected global oil prices. Economic indicators offer valuable insights into where commodity prices might head next. Inflation, for instance, can lead to higher commodity prices. When inflation rises, the value of money declines, making goods like oil or gold more expensive. In times of inflation, investors often flock to safe haven assets like gold, pushing prices higher. Employment figures also play a role. A strong job market suggests a healthy economy, which usually leads to increased demand for commodities like oil, copper, and agricultural products. On the flip side, weak employment numbers might signal reduced demand and falling prices. Consumer confidence is another crucial indicator. When people feel optimistic about their financial future, they tend to spend more, increasing demand for products and the commodities needed to make them. Manufacturing data, like the Purchasing Managers' Index, also signals how much demand there will be for raw materials in the near future. A higher PMI suggests more industrial activity, which boosts demand for commodities like steel or aluminum. Commodity markets are notoriously cyclical. Prices rise and fall in waves, often influenced by global events or market trends. A boom phase occurs when demand exceeds supply, causing prices to surge. This phase could be driven by factors like rapid economic growth or supply disruptions. But every boom is often followed by a bust. As prices rise, producers increase supply, leading to an oversupply, which eventually causes prices to fall. This cyclical nature of commodity markets is something traders and investors watch closely. Seasonality also affects commodity prices. In agriculture, For example, prices tend to rise before harvest when supply is low, then fall after the harvest when supply increases. Energy commodities, like natural gas, often see price spikes in the winter when demand for heating rises. Long-term trends, like the global shift toward renewable energy, are shaping demand in new ways. The demand for lithium, used in electric vehicle batteries, is increasing, while demand for coal and oil may be waning. How are commodity prices set? It varies by market. In oil, futures contracts traded on exchanges like NYMEX or the London Brent Exchange play a significant role. These contracts allow traders to buy and sell oil at a future date, with prices fluctuating based on expected supply and demand. Precious metals like gold and silver are also influenced by futures markets, but investor sentiment during times of economic uncertainty can cause prices to surge as these metals are seen as safe investments. Agricultural commodities, like wheat and corn, are priced based on both physical market conditions, such as weather and crop yields, and futures contracts. Base metals, like copper, are traded on the London Metal Exchange, where daily sessions determine global benchmark prices. Another critical factor in commodity pricing is currency fluctuations. Most commodities are priced in US dollars, so when the dollar strengthens, commodities become more expensive for foreign buyers, reducing demand and pushing prices down. Conversely, a weak dollar makes commodities cheaper, increasing demand and driving prices higher. Currency fluctuations also affect producers' costs. For example, a mining company in South Africa may benefit from a weak local currency, as their costs in local wages decrease when converted to US dollars. However, if that company needs equipment priced in a stronger currency, their expenses might rise. Central banks and interest rates also play a role. Higher interest rates usually strengthen a currency, reducing demand for commodities. Lower rates weaken a currency, making commodities more attractive to foreign buyers. In conclusion, understanding the forces that influence commodity markets is essential for anyone involved, whether producers, traders, or policymakers. The delicate dance of supply and demand, geopolitical events, economic indicators, and currency fluctuations shape global commodity prices, driving the pulse of the world economy. Mastering these dynamics allows us to anticipate market shifts and make informed decisions in this ever-changing landscape.